truly effective? And how do you get comfort that indeed those self-assessments, if they have them, are truthful or objective? How do you assure yourself that boards and the governance structure are effective? How well are they doing? Are they achieving the goals that are being set out? Is risk under control? Do the boards actually know the risks that their companies are exposed to? We had a discussion yesterday with Pablo Antolin yesterday about a very, very complex risk. And I wonder how many of the life insurance companies or pension plans you work with are comfortable with their identification and the measurement of the risks that they're really following. So, now we're going to get more detail. The structure of the talk today will focus on elements of ICP, core principle number 7, governance, and the associated standards. And we're going to dig in behind them and see what they mean to us as supervisor and what are our, I think, reasonable expectations. Corporate governance refers to the systems through which an entity is managed and controlled. Framework of an insurer. Promotes the development, implementation, and effective oversight of policies. Oversight in the way that I have been trained to look at governance is extremely important, and we are going to spend time talking about that. And defines the roles and responsibilities of persons accountable for management and oversight. The day-to-day management of a company is very different from the oversight roles that we'll expect. This definition has similarities, many similarities, with the definition from the OECD. But we focus here on oversight, or I focus on oversight, which is the independent review of operational management, looking at controls, risk, tolerances, compliance. Independent people looking to make sure that operational management is truly remembering that the business of insurance is not sell policies, sell policies, sell policies. There has to be done within a defined control environment to make sure that the insurance company does not stray from the safety and soundness considerations that we need. And this definition also defines the roles and responsibilities for those in management and those in oversight functions, distinguishing between the two very important roles in companies. Okay, continuing on with the notes from the general discussion of the core principle before we get into the standards. Governance sets relationships, or the requirements relating to how decisions and actions are taken, including documentation. Okay. I visit with a lot of supervisors around the world, an awful lot. And I have strong memories of when I was one of you. I was a Canadian supervisor. And how many times when I have spoken about governance to supervisors, senior or junior supervisors, how many times have I heard, oh, we've been asked to review the minutes of board meetings, committee meetings, etc. They don't tell me anything, Mr. Thompson. They're pro forma in nature. They just say that we met, here was an agenda, we approved this, and we adjourned. They absolutely are no help whatsoever. Here, in the preamble to the core principle, direction is given to you to set direction to the boards to how do they document their decision making. You have to give the boards your expectations. What are your expectations on what should be available? How does the board show that they have considered various alternative proposals? How have they addressed the risk concentration issue? How have they addressed that the risks that the insurance company takes on board are truly controlled? So here you're being pushed by the core principle to make your expectations known to the board and have the board outline in detail how they reach their decisions. That should be a new expectation of you. Okay? provides for communicating as appropriate matters relating to the management, conduct, and oversight of the insurer's stakeholders. You are a stakeholder. How are they going to communicate to you? What are your expectations, and how can you set that out? Have you, as supervisors, have you gone to the boards of all of your important companies? And all companies are important. Have you gone to the smaller companies as well? Have you sat down? Have you taken the time? Have you explained what your true expectations are of them? Do you have public guidance published where you set out what the supervisor does require, so it's no surprise to the insurance companies? These are the rational things that we're looking for. We expect you to be able to provide that for us so we understand, so you can demonstrate to us that you're doing your job effectively. And the governance structure provides for corrective actions to be taken in non-compliance, weak oversight, poor controls, or weak management. This is not setting out the expectation that it's okay for boards of insurance companies to sit back, be very passive in their work, to nod their heads when the chief executive presents the strategic plan, et cetera, et cetera. This is requiring boards of directors to be active, extremely active in their work. And if they can't demonstrate that to you right away, you are starting to doubt whether they are truly effective or whether governance really works whatsoever. Now, I'm a Canadian. I'm heavily influenced by some of the public announcements by the Canadian supervisor. Corporate governance refers to oversight mechanisms. Clearly, that's the first thing that they put on their statement. Oversight mechanisms, including the processes, structures, and information used for directing and overseeing the management. It encompasses the means by which members of the board and directors and senior management are held accountable for their actions and the establishment and implementation of oversight. OSFI believes very strongly that it is the boards and senior management that run the company. I think we will all say that, but sometimes our actions belay that. Sometimes supervision is very intrusive, and that can be good, but sometimes we're very prescriptive in what boards should be doing, very prescriptive on operational strategies, and I think we should be very, very careful about that. But accountability is key. We believe that the supervisor is accountable for his responsibilities. Individual supervisors in Canada are held to be accountable for their risk assessments and recommendations. And at the board level, the board as a whole, individual directors should be accountable. And how they exercise that accountability, how do they ensure what is going on? We will talk about structures that are recommended by the IAIS, that are recommended by the Canadian supervisor, which we think are effective and they work, and many other countries are adopting them as well. Okay? We're not talking about issues that are mathematically measurable. We're talking about matters of good judgment on the part of knowledgeable supervisors, how to tackle their work, develop relationships with boards, management teams, to understand exactly what they're doing, what the risks involved are those risks managed, controlled, and overseen? And that requires a skill in the supervisor that is not always present in every supervisory agency and has to be developed. As your expectations of companies in the field of governance increase, you have to increase your expectations upon what you as a supervisor can actually deliver. Okay, enough definitions for a moment. Corporate governance, CG, is particularly important for financial institutions, insurance companies. We know that. But if I visit supervisory agencies, talk to supervisors, talk to supervisors in my own agency to ask them to clearly tell me why corporate governance is held in such high, is so important for financial institutions. They usually stumble around and they can't give me a very, very coherent answer. So why is governance so important? We've heard before, insurance companies are in the business of making promises for the future, many years out perhaps. We talk about life insurance companies. The benefit might be realized 20, 30, 40 years from now. With the annuity company, we are promising a cash flow for the next 20 or 30 years. For a general insurance company, we're promising that we'll be there to make you whole in the event of an insurable loss. Also, policyholders are funding their own benefits largely. If the company is run well, the benefits received by the insurer are not received out of shareholder funds. They're received out of the accumulation, the pool of premiums that have been accumulated over time. Policyholders, by and large, pay for their own benefits. Certainly true with life insurance companies, and not so much as an individual general insurance companies, but pools of insurance monies paid for by policyholders pay for the claims. If you look at the balance sheet of a life insurance company or a general insurance company, the bulk of the assets on the balance sheet, those are provided by policyholders, not from the shareholders. Those assets, when they're in the insurance company, do not belong to the shareholder. They belong to the corporation. The shareholder and the corporation, it's very important to keep that distinction very, very separate. The bulk of the money on the balance sheet, the assets, have been provided by policyholders. We have talked about the interrelationship of insurance and to the well-being of the economy as a whole. There's been an awful lot of discussion in the academic papers, the professional papers, about the critical importance of banking, and insurance as similarly a critical component does not get the attention that the banking system does. But a modern functioning economy does not work well without a functioning insurance industry. Individuals will not find a way to protect themselves against unacceptable risk levels. Groups cannot find a way to transfer risk to a larger pool. Savings mechanisms will not flourish unless we have a good functioning life insurance industry, whether we include the annuities and the relationship with the pension business. There is an element of intermediation in the insurance business, particularly in the life insurance industry, but if we think about the savings component, the asset accumulations. Insurance is all about confidence. Confidence in the company, confidence in the system. Not necessarily confidence in the government backstop to insurance plans, but confidence in a private sector insurance sector, largely private sector, confidence that it will be there to respond. And some examples which you don't need to be apprised of: family loses its home to fire. A natural catastrophe strikes a portion of the country. Every time I work in Costa Rica, Tomas Soleil tells me his app on his iPhone says there was an earthquake 10 minutes ago. It was in this part of the country. We live in the world where we are susceptible to natural catastrophes, and if we rely on government remedies to put us whole after catastrophe, I think many of us will be in a position where we cannot resume our personal or our business lives. And of course, the life savings of insureds, depending on your system, are invested in annuities or other pension plans, and we need confidence that they are going to be around to respond when necessary. Okay? There is a difference between policyholders and shareholders. Policyholders are generally not knowledgeable about the insurance company that they might use. We expect investors to be knowledgeable, and we don't believe investors require the protection of a financial sector supervisor such as yourself. There are other remedies to look after the interests of investors, but policyholders are a special category, and they require the supervisor to look after their interests. And in most countries, the rights and privileges of policyholders are elevated above those of the owners of the company and perhaps other general creditors. Okay. Our job, by and large, is not to prevent the failure of insurance companies. Our job is to reduce the likelihood of failure by ensuring that the companies are run properly with respect to sound business practices, that they are safe within reasonable tolerances. So we need the supervisor to guide that, and we need boards of directors to ensure that the good corporate governance principles are in fact in place. Okay. Speaking to representatives of what we can call emerging market economies, even developed economies such as Canada, if the investing world does not have confidence in your financial system, of which insurance and pensions are a big part, the source of foreign capital will probably dry up. We've seen the event of the financial crisis. Flows of capital certainly slowed down. Flows of capital have dried up for certain countries for a period of time. And if the investing world knows that capital has great liquidity and can move very, very quickly. And during the financial crisis, capital certainly moved out of certain jurisdictions very quickly. So without good governance and the effort that you put into supervision, without good governance, the confidence of the wider world is going to be in jeopardy. And the last part here, universally agreed, banks, insurance companies, pension plans require a heightened level of supervision, and insurance companies, banks, pension plans require a higher expectation in the corporate governance that the boards of directors and senior management should be providing. Okay. Quick picture, a very simple picture. And corporate governance does not work in isolation. Boards of directors do not sit at the top of the hierarchy. They need information coming from senior management. They need information coming from the operational management of a company. They will get a lot of operating statistics, but they also have to get information, they have to get confirmation that the controls that they have put in place actually work, that the risk tolerances that they set for the enterprise are being observed, are being followed. They have to get information that if risk limits have been violated, they have to be told early. So again, from the top down, instructions can flow that violating risk limits is not acceptable, not following the control processes that were put in place, not following by operational management is not tolerable. So it's a continuous loop. And what we're going to talk about subsequently is how those loops actually work, what sort of information and processes that the board needs to have in place to make this effective, and based upon the information that they gain from the industry, or from their company, what directions they give, what sort of corrective action they put in place, and how quickly that can be done. This is a chart which was from a textbook which has nothing to do with financial institutions, and a colleague showed it to me. And I want to consider that good corporate principles are not just for insurance companies, not just for banks, but they exist in all enterprises that are trying to flourish, look to the future, and protect the rights of their stakeholders. They probably don't have a supervisor as a stakeholder, but to look at what a board should do, they direct the affairs of the company, establish appropriate policies and procedures for governance and risk management. They protect the stakeholders. They connect with other directors to form a body that hopefully has the wisdom, the experience, and the integrity to challenge management when necessary. They should expect appropriate governance and actions by management and take action when it's not there. They're the ones who appoint the chief executive, and they're the ones who fire the chief executive if necessary. They correct the company's course where circumstances require, and inspect the oversight function, ensure that policies and procedures are adhered to. And that is a lot tougher to do than those few words actually point out. In terms of insurance companies, we can define a few of those. Boards of directors, they establish risk tolerances. They approve the overall strategic direction. Senior management comes up with ideas for the strategic direction, and they make their proposals, but the boards approve it, modify it, reject it. The board ensures controls, not the minutiae down at the very bottom at the operational level, but the general framework of controls would have to be in place. They work for the well-being of the company as a whole, the corporation. And this is the protection of policyholders in the broadest sense. If the company is doing well, if the company manages its technical provisions well, if the board ensures that risk tolerances are followed in risk selection, risk rejection, risk accumulation, if the corporation is doing well in those regards, the policyholders are in good hands. Monitor performance, required changes if necessary, and monitor all elements of risk management. Okay. This is the core principle. We saw that a few moments ago, and I have no idea what that little box is, but I think it's beyond my control to make that disappear. Okay, so we've seen the principle. The principle is supported by, I believe, 10 standards. And these were chosen with a lot of deliberation. When the core principles were revised and published, end of 2011, there were significant changes to the standards reflecting good governance. And each and every one of these, I think, can be very, very helpful for you. They can help you focus on elements, that some of what you do already, but help you focus clearly, okay, what is really important. Okay, number 7.1. The supervisor requires the insurer's board to set and oversee the implementation strategies, objectives to achieve. Clearly telling the board to set objectives. The board is not the daily operational management of the company, and there should be a separation. Obviously, in smaller companies, that is not possible, and we'll find ways to how do we balance where senior management are running the day-to-day operations of the company. This includes setting definitive statements about risk appetite, specifically what tolerance is to be and how it should be measured. Setting a risk tolerance at the board level and not paying any attention to it, why bother setting the tolerance? Why bother at all? What is tolerance? Specification, general guidance on what is the maximum size of policy limits. What should be the maximum net retained line for any insurance company? What should be the credit exposure? From reinsurers, or maybe from the investment portfolio, or maybe from individual policyholders. Set the strategy and limits for liquidity. Set the reinsurance strategy and the framework of how to ensure the strategy is effective and controls the risk in that operation. The board should set expectations for economic capital, how high it should be. They, of course, will be aware of your own capital index that your supervisory sets. But that's only the start. The board should set their own limit of what they believe economic capital should be, preferably higher than your capital index that you have set. And we want a clear statement on compliance. We want the board to oversee that compliance management works at the company. We want them to do the work on checking or the checks and balances to make sure compliance components are adhered to. We want you to be able to review their work, that it's been robust enough, that you do not have to do the laborious process of checking every compliance issue. That's their job. Okay. 7.2, appropriate allocation of oversight and management. This is actually a standard which I think is extremely important. They're all important, but this is one based upon my past history as a supervisor, really gave us a lot of support for the work we did. Okay, oversight, segregation from operational management. Oversight needs to be independent from operational management for it to be effective and reliable. Companies that do not instill oversight processes are subject to relying upon the underwriting department coming back and telling you, don't worry, board, everything's fine, we're following the controls, risk is under control, everything's great. Everything's great. Policy count is going up by 30% a year. Don't you worry. We're in good shape. I worry very much about that. The responsibilities have to be clearly laid out by the board. What is the role? Specify what is the role of risk management. Does risk management actually exist at the company, or is it handled in another manner? Am I a small subsidiary operating in your company? And it makes better sense that I will utilize the risk management resources in the home office as long as they are sensitive to the risk exposures in your country. There's a good argument for that, but you have to be involved in that discussion. Similarly, they should define what is the role of internal audit. Internal audit is important. Who does internal audit report to? Does the chief internal auditor have the ability to talk directly to the board of directors, especially if there might be a disagreement with senior management, how we handle compliance? We heard a lot of discussion yesterday from many, many countries that they're adopting a risk-based supervisory approach, SBR. And, okay, that's tremendous. I think a good risk-based approach will truly make you much more effective supervisors. If you are going to follow a risk-based approach, be prepared to spend a lot of your time in the area of governance and oversight. Identifying the risk is critical, but just as critical is identifying how those risks are managed, controlled by the board, senior management, chief internal auditor, chief risk officer, etc. You'll spend more time in those areas, probably not very comfortable because we don't have the clear definition of quantitative measures to rely upon. We're looking at behavioral aspects of management, and it's very difficult, and many of us are very uncomfortable doing it. But that is where the focus of risk-based supervision is. Okay? Composition of the board. And this is an area that often we get tied up. In a few slides, I'm going to talk about independent directors, independent of ownership, independent of management. The core principle talks about the board needing to be independent of ownership, but it talks about the board as a whole, not individual directors. But let's focus on individual directors. Members have to be effective, the right mix. If we have a lot of people sitting there nodding their head because the owner/chief executive controls their appointment and their remuneration, Well, we can go through a list of all the elements that corporate governance should have. We need 12 directors. They need to meet 6 times a year. They have to have these committees. But if all they do is nod their head, what's the point? Your job is to identify where the board is not effective. And I think there are ways to do that. I think there are ways to develop that. But we have to have people, we have to have directors that will act independently. They might be closely related to the company, but they have to have the ability to act independently. Okay? Sometimes, and maybe too much, we focus on how can boards be independent if there's one shareholder? And I think there's solutions. I think we've seen evidence where boards do speak up, and then we should understand what are the traits of effective boards? What makes them work? I think the area where we've seen we have greater difficulty in boards being effective is when the company might be very widely held, but we have a domineering chief executive. He, she, they come in various guises. I don't know if mutual insurance companies are prevalent in Latin America. They are in North America. There are no shareholders. How does the board effectively challenge a chief executive who's been firmly established? Perhaps she has built the company up. Chief executive controls the director nomination and selection process, and probably or possibly has stacked the board with like-minded people. I was scratching my head last night, and we always think about the origins of the latest financial crisis. And we heard stories of the large American banks that failed, were bailed out, UK banks that failed or were bailed out, European banks similarly. Every one of them was very widely held. Every one of them had a very domineering chief executive. Everyone had a board that on paper was above reproach. They just didn't do their job very well, did they? My organization runs a case study on the failure of Lehman Brothers. And when I first read it some years ago, in the half year leading up to the failure, maybe 9 months leading up to the failure of Lehman Brothers, reports came to the board from the risk management office. We have breached a risk limit. We have breached another risk limit. We have breached another risk limit. Not much happened at Lehman. When they started corrective action, it was far too late. One of the best ways to avoid making a decision on violated risk limits, increase the risk limit. Listen to the chief executive and don't worry, things are great. Growth has never been better. We have risk covered off. It doesn't sound like to me there was independent oversight to go in and look at the level of risk and look at the risk accumulation. So be very careful when we say that closely held organizations are impossible to have good corporate governance, because I don't believe that's true. Many widely held organizations have atrocious governance. And so let's get away at looking at characteristics. They have X number of board members, that and that. And let's really go in and talk to board members, talk to other interested parties. There's a feedback loop from board of directors down to senior management. It might feed through internal audit, might feed through risk management. We talk with them as well. Chief internal auditor, are you being supported by your board? You have a problem with senior management, you've taken it to the board. Is the chairman or is the audit committee, are they supporting you? No. I am coming to a conclusion that we've written down all the nice things on paper about governance, but truly it's not very effective. Oh, if you're truly going to follow the risk-based approach that we talk about quite a bit, the type of work that you do as a supervisor is going to change quite dramatically. Mm-hmm. Okay. Expectations of individual directors. Very important. From where are they selected? Who chooses the directors? Do you detect that they have any dependence on the chief executive, the owner? Are there business relationships which might make them less than independent? And when we talk to independent board members, and we will talk to independent board members, do they really know what is expected of them? I have a little aside. I work in a country in Africa, and they're developing a framework for risk-based supervision. And after working with them for a few years, and I think they're making good progress, they have their limitations, and they came to me and said, Mr. Thompson, we are developing what we think are good practices for our country in Africa. They got smart people. And they say, but, everything you talk about risk-based supervision talks about the interrelationship with boards of directors and individual directors. We, as the supervisor, were extremely worried because we think the country has X number of insurance companies, in aggregate 240 corporate directors. Our corporate directors do not know what is legally required of them. They do not know, they've never heard of the core principles from the IAIS. Well, that won't be surprising. They don't know how to behave. They do not represent the company as a whole, but they are stooges of the owner. The companies are very closely held. They are business partners, et cetera, et cetera. How do we cross this big chasm we have that if directors don't know what is expected, how are they ever going to be effective? Their solution, and it's happened elsewhere in that continent, they are going to have a mandatory directors college. Every director is required to attend. They'll make certain dates. We are helping them design the curriculum. But every director is required to sit in a room like this for 2 days and have an open discussion about what are the expectations of the supervisor on you. It's your duty to act independently of ownership. It's your duty to have good judgment. It's your duty to make decisions that are in the best interest of the insurance company. It's your duty to keep your supervisor informed when things go wrong ahead of time. And the final message to those directors will be that if you don't think you can discharge those responsibilities, the commissioner will be accepting your resignation at the door on the way out. So maybe that's extreme. Maybe. But we have to ensure that directors who come on board really know what is expected of them. And you can help. You can help. In your published guidance, you can explain what is required of corporate governance. What do you need? We need you to fully explain, detail your rationale for reaching important decisions. We explain on paper. That is, the board has a duty to come to you as a supervisor to tell you when there's a problem. I'm going to talk about that more because that's important. So, individual directors have to know their responsibilities. Supervisor requires the board to provide oversight in respect of the design and implementation of sound risk management and internal controls. This requires work. This requires a knowledgeable board. They are setting the framework. Most of your board members are not going to be trained in these fields. How do they know how to set an appropriate framework? How do you as a supervisor know how to design an appropriate supervisory framework? You know, 3 or 4 of us don't go off in a room and say, for Suhazy, we're going to sit down over the weekend and draw up a new supervisory framework. It doesn't happen. It's far too complicated. But Thomas Soleil, through assemblies such as this, you exchange ideas, what work, more importantly, what doesn't work, and we gather information. You also call upon advisors from OECD, from other countries that have done similar work, and you look for good ideas, and you test drive them. Do they work? Are they going to be applicable? The economic and the socio-economic reality in Colombia is different from Salvador. Designing a system for supervisory effectiveness will be very different. But they're going to follow certain elements that are, I think, universal around the world. Similarly, for directors to devise a governance framework, a control framework, an oversight framework, can they do it themselves, especially with small companies? And here, they should come to you and talk to you, but you don't run the company. They should look outside their country, maybe their trade association, maybe their parent, or maybe hire outside experts. There is a tendency that many small organizations think that they can do everything themselves, and frankly, they can't. So this requires a lot of work. It's not sitting back as a board of directors asking senior management to design everything because you want to oversee senior management. It's like asking the fox to design the fencing system around the chicken coop. Oh, down the hall there's a meeting of the chicken or the poultry and egg producers. You know, they'll probably like that analogy. But okay, so the job is difficult. A lot of focus on remuneration. That is the responsibility of the board for the senior people. And there's been so much talk about that. The remuneration system has to align medium to long-term results. It has to encourage and reward the good behaviors that we're looking at. But I like to look at this even further, that the board sets the risk culture, control culture, customer care culture at an insurance company. Culture has to permeate down to the bottom levels. If we just focus on the remuneration strategy for senior managers, but all the people down below, underwriters, if that culture does not apply and permeate all the way through the organization, controlling the salaries of a few executives won't make any difference. The damage will be done down below. Often in groups like this, I mention, often I try to draw on practical experiences. My son, he's a young man, and he works for an insurance company. And he's an underwriter. And I think it's a great job to have. And he's always coming back and telling me when we meet about these strange things his management is doing to him, these controls that they put on him, limits on his remuneration, and he can't figure them out. That's because he's never sat in this room to understand that there's a very tough risk culture in his company, and the management is pushing that culture down below, saying you cannot underwrite these risks, you can't do that. In these instances, you have to arrange for your facultative cover, etc. He thinks all these things impede his ability to generate business, and of course his bonus. But hopefully with age and maturity, he'll understand that good controls, risk management are important. So he might have a job with his company in 10 years from now because it won't go bankrupt. So remuneration is also affecting the culture all the way down through the organization. Okay? Accurate financial reporting. Who can argue with that? How many people, some of you in this room, tell me that they cannot rely upon the financial reporting from the supervised companies? Well, it's intolerable. And this is the responsibility of the board. Prime responsibility. If you cannot rely on the financial statements, the regulatory statements you require, and the MIS that backs it up, the detail that supports the operating financial work that's being done, this is intolerable, and the board is accountable for that mess, and they should be, and your criticism of the board should be scathing. Financial reporting is a tool that you depend upon, financial reporting as a tool for proper disclosure to the marketplace. And if it's not accurate, the board is fully culpable. And now, whoops, this is good, 7.8, very important. Supervisor requires the insurer's board to have systems and controls to ensure the promotion of appropriate, timely, and effective communications with you, the supervisor. That is absolutely critical. And maybe a new mindset. Certainly when I was a supervisor many years ago, learning my trade, in the late 70s, the 80s, this would have been unheard of. Companies, boards of directors would never go to a supervisor and say, we've made a mistake. We've had a very large loss. Our control mechanism has failed. Systems have crashed. They would never do that. Well, the world's changed. You are a stakeholder, and they are to come to you. You are to make that extremely clear, and I believe it's important to sit down at boards of directors, each and every one of them, and make this very, very clear. Directors have a responsibility to come to you as a superintendent and saying, we've got a problem. Hopefully, the expectation is, we've detected a problem. This is what we're doing to fix it. This is our timeline. We will keep you apprised of the progress that it's taking. Okay? They should tell you about large material losses that adversely affect capital, failures in control functions, if they've found that they've exceeded their own risk limits, if the capital ratio or indice is falling below their own internal target for economic capital. Your supervisory target or index is critical, terribly important, but so is their own internal target. And this falls out of the ORSA discussion that I don't think we're talking about today, but responsibility of the board to set their own capital, economic capital levels. If they fall below that, but they don't breach your target, you still want to know. It's very important. Now, if the board or management does come forward, as you want them to do, and they tell you of an impending problem, something which has occurred, what do? If your first response is sanctions, oh, we're going to fine you, we're going to fine you. Do you think they're going to bring their problems to you at an early stage in the future? I don't think so. So I want, I'm not a big believer in sanctions. I'm a big believer in changing managerial boards' behaviors. I think it's got much more benefits down the road. We heard yesterday that sanctions, albeit very small, some companies view them as a cost of doing business, and that cost is just passed along to the policyholder. I think changing behaviors and working with governance is much more effective. So if a company comes and tells you we have a problem, whatever it might be, you want them to tell you what went wrong, why it went wrong, what they're going to do to fix it, how they're going to fix it, and give you a timeline, and I will keep you apprised. I will call you every month, superintendent, and we'll tell you the progress we're making. I think we'll fix something that's gone wrong, thereby giving greater credibility that the problem will not recur. Okay? Okay. Culture. The board promotes the culture of sound risk management, compliance, and fair treatment of customers. Most of you have a job as a prudential supervisor and a market conduct supervisor. And quite frankly, it's only after I left Canada's prudential supervisor that I really became convinced that market conduct is every bit as important as prudential supervision. I think in Canada I belonged to the supervisor and they were solely prudential, and there were other organizations that worried about market conduct issues. Having never worked in that field, I didn't fully appreciate the challenge and the difficulty of working in market conduct. And, smarten up. if we believe in confidence in financial systems, if we believe that policyholders are not as knowledgeable about their rights and privileges and what should be expected as investors are, market conduct is really important. Because if market conduct excesses are totally egregious at a company, that has very long-term consequences on the prudential side, and it causes problems for the policyholders that are unconscionable. So we have a culture. We have a culture, a statement, okay? Sound risk management, compliance, and treatment of customers. Maybe we should put treatment of customers up front. But the board's responsibility is to do that. And the last standard, this ties in with our approach to risk-based supervision so well. The supervisor has the power to require the insurer to demonstrate the adequacy and effectiveness of its corporate governance function. Boards have to convince you that what they do works. Your job shouldn't be going in, playing the guessing game, looking under rocks and things like that. Sit down with the chairman. Sit down with the head of the audit committee, the risk committee, whichever committees they might have in place. Tell me how you have convinced yourself that what you're doing is effective. Show me the processes. They can't pull out the minutes of a board meeting, which are half a page long and don't show anything. Well, that's no good. Tell me how you reached your decisions. Tell me how you've established the framework for oversight. Tell me how you've developed a mandate for your internal audit department. Tell me how your internal audit department is responding. Tell me about how the private conversations you've had with the chief internal auditor without the chief executive being in the room. Start showing me the evidence that you are truly effective. First of all, the company benefits because they have a good functioning governance system and they will reap the rewards. Secondly, the company will benefit that they will convince you that they are running and overseeing their company properly, and you don't have to go in and dig and spend a lot of time. They have to convince you with the evidence that they have. Okay? So each one of these standards, if we really look and think about them in our own context, they are designed to empower you as a supervisor. It would be helpful if everyone in the insurance industry knew all these standards. It'd be helpful if every one of your staff members knew all these standards as well. Maybe when you go back to your agency on Monday, give all your staff homework, because these are very important, because these will help design the way you're going to do your work. Okay? Time is marching on. Corporate governance. Now, if I was writing the core principles and writing the standards, I would have been probably tempted to put the standard supporting risk management into the corporate governance standard. I think they're so closely related. And we're just going to go through them very, very quick because time is limited. Okay. Supervisor requires an insurer to have, as part of its overall governance framework, effective systems of risk management controls. Good, no argument. Supervisor requires insurer to establish, operate effective systems of risk management, control functions with necessary authority, independence. These are all things that we support. And have a compliance function, have an actuarial function, have an internal audit function, and control outsourcing. Those are all good things to have, but can every company have them? This looks very similar to the framework that we use in Canada. And Canada is strong supporter of the IAIS. And did Canada come up with everything all by itself? Of course not. Canada relies upon the collective wisdom coming out of international forums such as the IAIS. But this is a list of the control functions, whatever they mean, that we have in our framework. Control functions include, well, we put them in as board, senior management, risk management, internal audit, actuarial, compliance, and financial. Sounds pretty similar to what is recommended by the IAIS, and I don't think that's any accident. In your companies, are you going to see these areas of oversight in every company? Most certainly not. To set these things up costs money. And so we have to bear in mind the admin, or we're always admonished to remember size, complexity, nature of the business, and what is proper, what is effective for the operation as a whole. Okay? But we're going to look at a few. And these are taken from guidance that OSFI puts out so the insurance companies knows what is expected of them. And I was going to talk about boards of directors and senior management. Boards of directors are responsible for stewardship and management oversight. Key responsibilities: ensure management is qualified, review and approve organizational and procedural controls, ensure principal risks are identified, review and approve corporate risk policy, review and approve policies of major activities, review, provide. If we look at the verbs in there, they do a lot of checking. Boards of directors are not the people out underwriting policies, settling claims, or whatever. These are all designed to make sure other people are doing what they've been told to do. These are ensuring that senior management, operational management, they're following the system of controls. They are following the regime of good risk management. They're setting in place an independent way to ensure that their strategy, their direction, their risk management vision is being followed. So I remember that. They are making sure other people are behaving safely and soundly. Senior management, well, they are doing things like developing strategies for approval by the board, developing practices. They are developing good governance practices within the body of the company with the approval of the board. They ensure the board is kept well informed. Okay. So on a page or two, the differentiation between what management does and what the board does. Okay. I am cognizant of time, and I'm going to skip forward some slides. I believe the presentation is available to anyone, but we're basically having a discussion that I'm going to go through, or skip over, about the discussion of independent directors. And yeah, except for one important component of it. There's a lot of pressure out in the world to say that a certain number of directors have to be independent. And then on the other hand, you'll have companies tell you, where do I find them? How do I find independent directors that are knowledgeable? How do I find independent directors that know anything about insurance? How do I find independent directors that know anything about investment, portfolio theory or whatever? Where do I get these people from? And I don't know. I think a degree of independence is important. Canada does not have a rule saying a majority of a board of directors has to be independent. We don't. And we're a developed nation, and we got lots of people that have lots of skills. But the way we address that is to see if a degree of independence will be exerted. Canada requires a board to have a minimum number of committees, and we have 3. Every board should have an audit committee, not surprising. Every company should have an investment committee, absolutely critical for the well-being of an insurance company. And every board, because our history we had problems, every board should have a conduct review committee. What does that mean? A conduct review committee is a committee that reviews every transaction with an economic entity that might be related to the owners or the corporation. Historically, we had a lot of problems with companies, and they failed, that they had a lot of or they had a lot of related party transactions with friends of the owner and things like that. And we said never, never, never again. So we have strict limitations on transactions with a related party. Many of them are outright banned. And if any are made, the composition of the Conduct Review Committee, composition of the Audit Committee, composition of the Investment Committee, that is where we say the majority of directors have to be independent, because we feel those are three critical ideas. But we do not say the majority of the board. So people have to be left to wrestle with, is it more important to have qualified directors who know the business, who understand the risks? Or is it more important, who might be not legally independent? Or is it more important to have independent people, but they might not know the risks of the insurance company, know how an insurance company operates? Okay, usually the answer will come down to be, we want a mixture. We want a mixture. I think having some degree of independence on the board is vital. You know, all directors have a duty of care, but having outside people, I think that brings it home. And just because a director doesn't come from the insurance world doesn't mean that they don't bring other very, very important talents to the table. So, but your job as a supervisor is to assess the board as a whole, to make sure that they are effective, et cetera, et cetera. Okay. So we're going to move through this little bit quickly. Yeah. Yeah. I want to focus on, and I'm on, the crux of why we're here. I have about 40 minutes. How can financial supervisors improve the effectiveness of corporate governance in companies? Okay. And these comments are taken from a publication of the IFC, International Financial Corporation. The IFC is not a supervisor. After the financial crisis, the International Financial Corporation, they did a lot of reviews. A lot of reviews of what went wrong in 2007 and 2008 have been undertaken by many bodies around the world. And I certainly don't have time to read all the literature, and but many, many august bodies. And I'm sure if we delved in, or if we put Yoshi up on the stand, he could talk for the remainder of the day about the observations and the findings of what have come out. But this is something which I think is important. I came across this paper. I was referred to it. And it focuses on what we do as supervisors so clearly. Okay. And I like the wording. I think it's helpful to us. Corporate governance is a historically grown set of lessons learned from experience. Yeah, I don't think corporate governance is a science. It's not developed by the scientific method. It is the accumulation of our observations of what works, what doesn't work, why does it work, why does it not work. Weak and ineffective corporate governance is in systemically important financial institutions, and every financial institution was an important contributing factor to the economic crisis that began in 2007. And they're going to go on and build on that. Many banks, many insurance companies have successfully tackled the challenge and improved their governance, mostly on their own, sometimes with guidance from their supervisors. So it's inviting you to provide guidance where it's needed. Regulators and supervisors are important stakeholders in financial markets. Well, we've covered that before, so I'm glad they agree. The focus on corporate governance in the pre-global financial crisis era, before 2007 or 8, focus on corporate governance was primarily on the characteristics of governance. Characteristics that are observable and measurable. This study that was sponsored by the IFC was focusing on supervisors. And what did supervisors do around the world? What did they do in the countries that had the systemically important financial institutions that failed or needed government bailout? And I think the lessons learned are very, very appropriate to us. They focused on characteristics. You have a board of 12. How many are independent? How many committees do you have? Do you have an audit committee? Do you have an investment committee? Do you have a risk committee? Do your committees have mandates? Yes, we do. Does your chief internal auditor have access to the board of directors? Yes, he does. Do you set remuneration policy for senior executives? Sort of, yes, we do. Et cetera, et cetera. And we can draw up pages of characteristics that we think good governance would exhibit. We can observe them. They exist. I can measure certain things. I can tell you how many times you meet. I can tell you what maybe some things you talk about. But writers of this article, both very senior supervisors in their own right, they concluded we as supervisors didn't look to see all these characteristics. Did they work? Did your board of directors actually work? Did it challenge management? Did it, okay. Did you challenge management? Did you say that risk accumulations are growing? Did you insist on immediate change if risk limits were surpassed, et cetera, et cetera? And the conclusion was that we focus on so many things that were easy. We can take a sharp pencil and check it's there, but we didn't assess, do they really work? And that hit home to me because when my agency brought in risk-based supervision, it was drilled into us. Checking boxes doesn't mean anything, Mr. Thompson. Understanding how the processes actually work. And for the countries that are really embarked on a modern risk-based system, they will agree with me that it's difficult. So, more on that. Governance of financial institutions was not sufficient to prevent the behavioral excesses that contributed to the crisis. Were the members on the boards unqualified? And we've seen so many examples where the boards were comprised of stellar individuals, really high-ranking, powerful people. Yeah, but maybe they sat on 12 boards of directors and had no time to apply to this institution. Were the boards poorly structured, not the right committee structure? Did boards have the wrong mandates? Et cetera, et cetera. Maybe those are characteristics. Nothing there says, did they do a good job? Or, did the boards fail to challenge management, become cheerleaders? Cheerleaders were growing, unlimited liquidity, low interest rates, perpetual growth, growing profits, stock option benefits. When everything is going extremely, extremely well, it's very difficult to be the naysayer in a group of happy people who are watching their bonuses grow and grow and grow. But the conclusion was exactly that. Did boards of directors become cheerleaders of a very omnipotent chief executive that everything was going well? Everything was going great. Okay? Same paper. The responsibilities of the board of a financial institution are often more onerous than those of boards of other types of enterprises. I think that's very true. because of the nature of the insurance world, the banking world, where, how we said, policyholders, depositors put the money up. They build the balance sheet. Financial institutions are licensed by the state to take the money from the public. How true. They take deposits, manage investments, insure policies. Boards have both explicit and implicit obligations to safeguard monies and ensure that they remain available for the purpose for which they were entrusted. Can't argue with that. To ensure that financial firms are managed in a safe and sound manner, and to be in compliance with relevant legislation, regulations, and guidelines. Good. They've asked the question, in the guidance that many supervisory agencies distribute to their staff members or maybe make public to the institutions, what does the supervisor focus on? Characteristics or performance? So, I think their conclusion was they focused on characteristics. Characteristics, board reviews of policies and procedures. Will they review it? What do they change? Composition of boards. Are there committees, etc.? What are the mandates? Are board members independent? Yes, no, how many? Frequency of board meetings, appointment process for the boards. But do these really show you anything? Do they help in evaluating the bank's corporate governance policies and practices? And their conclusion was no. So, they came up with 5 suggestions. And they are things that I embrace. And I think they belong in any modern supervisory framework. I think they are in the framework that Suhazy is developing. And this will not come as any surprise. Review agendas and supporting material for meetings of board and board meetings. But what if the agendas and supporting material are not very helpful? Then go back to that standard and said, this is not good enough. Insist, demand, cajole, persuade, enforce that there has to be sufficient rationale for what is going on. Do the agendas address key risk areas? Do we have time? And do you find evidence that there is proper discussion and challenges? Push for that. Standard 7.10 requires the board to demonstrate to you they're effective. Do this. The board's responsibility. Focus on what actually takes place in the meetings of the board and board committees. Review minutes. Is there wide participation, etc.? Are there refusals to accept management recommendations or granting of approvals with conditions? Challenge management. Don't accept everything. Are there requests by the board? Are there requests of the board followed up? Easy for people, and we're all guilty of it. We make recommendations to our companies. The board makes recommendations. Your next board meeting's in 3 months. Who remembers? Well, that's just laziness. So they better follow up. We want you as supervisors to hold periodic meetings with individual board members. Seek information about how the board actually works and its committees carry out their work. Attend board meetings. Now, I'm going to conclude on that comment in about 20 minutes, but how do you develop your relationship with the board? We all have many companies. I know supervisors who will go to a board meeting only when there's a problem. Supervisory team has gone off and they discovered that technical provisions are understated. Risk limits have been exceeded. And, of course, multiple compliance issues. What sort of a relationship do you develop with the board that if you only show up when there's a problem? This is wrong, this is wrong. That's what you talk to management about. And if it's important, certainly talk to the board. But you should also, and this says talk to the board periodically. Your important companies, the bigger ones, and I don't want to insult anyone by saying a small company is not important because it is. I'm a firm believer, and I've spent most of my life working with small companies because they are a challenge. Every company is totally important to their customers, but let's look at things from a systemic point of view in your country. You will focus more time on your larger companies. You should develop a protocol where you meet with the chair, maybe the chair of the audit committee, maybe the chair of the audit committee and the risk committee, or a couple of independent directors. Meet with them regularly. Now, you can't meet with the board 3 times a year. The gentleman from Colombia is not in the room, and I asked him how many financial institutions he's responsible for, and it's about 350. How many board meetings can he go to? And we're going to talk about how we can manage that. But to develop our relationship, just don't go when disaster is brewing. You go regularly to tell them what you're trying to do, get them to understand what your requirements are, and develop the protocols where they start talking about the risks that they see in the system, the risks that they see at their company, because what great information to take to the other companies, protected of course, but to form a good view of how well-informed directors really see the development. So improve your interconnectedness with the boards very, very differently so they really understand. And in some ways, they are forming a relationship with you. They understand your position. You understand their position. You will have a solid basis for talking. If we get into crisis management, you have a good basis for a fair, honest exchange of opinions. You can't do that at the last moment. Active on-site supervision. I'm a big proponent. And in my early career, I was an off-site guy. I was an analyst. I think I was pretty good. But at my choice, I became an on-site person and spent my life visiting insurance companies. And it was only then, when I was actively an on-site supervisor, examiner, that I realized that until I assumed that role, I didn't have the faintest idea of how insurance companies were managed. I think I had a good idea of technical risk. Yeah, pretty good in mathematics and things like that, but I didn't understand the management and the governance processes. So please, 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 if you want to be effective, active program of on-site supervision. Many companies, a lot of supervisory work is carried on off-site. I'm not denigrating the value of that. That analytical work is critical. Constant follow-up with the companies, constant contact. You can't always go to the company. Off-site work is critical. But for governance oversight, off-site supervision cannot and will not ever be effective. Encouraging a tick-box approach. How many directors did we meet? I get a return from corporate directors twice a year in Canada. Who cares? I might know if someone resigned and I might want to know the reasons, but I won't know how they're governing the company. And verifying characteristics, but ignoring performance, which you can only do face-to-face. On-site supervision promotes the development of sufficient knowledge of the company and its business practices. And this is something that we do promote, and I'm going to show you a sample matrix of how certain countries, they look at the business of a company, they identify their risks, and it's a scorecard of how they measure effectiveness. And I'll show that to you, but this is important. You have to know the business of the company. If you don't do that, you will not understand the major risks and the vulnerabilities. Lack of understanding of the institution and its risks will never allow the supervisor to assess the effectiveness of governance in controlling the risk. Develop good understanding of the key risks, okay? And one thing, do each of us as supervisors, are we experts in every area? The answer is assuredly we are not. We're all pretty bright guys, but I'm not going to be an expert in everything. And well, I won't even mention longevity risk. Okay? We can't be experts. And depending on the size of your organization, do you have experts on staff? Well, don't be afraid to go outside your organization. If you've got something where you think something is out of your capabilities, bring in outside experts. Yeah, they'll cost, but the cost of bringing in outside experts when necessary is minuscule compared to not doing that and something going terribly wrong. Risk-based supervision requires that we build up the necessary skills that we have, and we like to see, ideally, risk specialists should be in-house. But that's not always going to be possible, and we know that. Engage the board and key committee members proactively. Regular meetings with board. Remember what I said. Don't go just when the company is blowing up to present your ultimatums. Many years ago, I was involved as a supervisor with companies that were on the verge of failure. Back then, the supervisor didn't have the necessary tools to intervene early. And you would watch a solvency index decline to the point of legal insolvency when you could do something. Oh, I wonder why it took us so long to change that. And we didn't get better tools until 1990. When did we go to the board? Basically, right at the verge of insolvency, to read the riot act, tell the board, you either put money up or you're going to die a natural death and we will close you. And we closed many. That's no way to work. If in the modern way of looking at the world, regular meetings with the board, committees, individuals, to seek their engagement to make the supervisory/governance process work for both parties. There are great benefits of having the supervisor fully informed of risk management, and governance at the company, that the supervisor is on board saying risk is being managed well. That's very beneficial to the company. This provides an opportunity to ensure that board members understand your concerns, and provides, the meetings provide corroborative evidence on the quality board performance. Can't do that sitting reading paper returns. Okay? And we're getting to a stage where I think I can close up. This is a picture of how the Canadian supervisor views governance at an insurance company. It's a hierarchy. And here's the supervisor at the top, overseeing to make sure things are being done properly, and if they're not, intervening. And risk management and oversight responsibility, an umbrella. The board is, the picture used to have all these arrows. They've all disappeared. The board is at the top. Senior management is accountable to the board. Senior management is accountable for risk management, internal audit, compliance, financial, whichever control function you think is necessary. And these functions also have dotted line reporting to the board, so they do have access to the board. Okay? That is how we view the world. And of course, the job of the supervisor, we look at the businesses of the insurance company down at the very bottom, lines of business, maybe commercial property underwriting, maybe annuity sales, maybe whole life health insurance or whatever. We look at something which is not a business but a function such as asset liability management process to make sure it's robust, and other processes on which, if they didn't work well, the company cannot survive, such as information technology. That's the business on the bottom. And then we understand the people who run the business. And now here are the people in the middle, small number of people, risk management, audit, compliance, to make sure operational management is following the control protocols that have been established, following the risk tolerances that have been set up, and ensuring that good treatment of customers is top of their minds. So, a structure. And we've seen the control functions before, and we've seen board of directors, senior management, risk. Okay. For each of the control functions that we didn't talk about, the supervisor provides a 3 or 4 page document, piece of guidance that is made available to the companies to tell them what we expect in risk management, what the supervisor expects in internal audit, what we expect in an actuarial function, which is going to be largely absent from all except the largest insurance companies, compliance, and a financial function. They're all available on the Canadian website. Fascinating reading, but importantly, it's the expectation, and it gives the companies an idea of how you, as a supervisor, measure these characteristics and how those characteristics are used to ensure performance. Okay? And that's a bit of supervisory philosophy. I'm going to go ahead. Every risk-based supervisory framework will end up with some sort of an assessment scorecard of how we arrived at our conclusions on risk assessment, and often called a matrix. And this is a modification of one that they use in Canada. I could look in many parts of Asia, I'd see something very identical. Parts of Europe use something very similar, and they're being used in Africa. And remember, we said, being on site, we really want to understand what we call significant activities, but business units, business functions. If we're dealing with the investment portfolio of an insurance company, we're looking probably most at the market risk and the credit risk, depending on what we have. If we're looking at the labor risk portfolio of a company in your country, we're looking at various insurance risks or whatever, and similarly. If we're looking at the annuity business, of course, we're looking at longevity risk. So we break it down with enough granularity so we can understand the business, lines of business or a process, okay, asset liability management, so we can isolate what the risks are. Then we want to see how operational management is controlling those risks to make sure that we don't have undue accumulations, et cetera. And then we're looking at maybe internal audit, maybe we're looking at risk management, maybe we're looking at the board, specifically, say, in the annuity business, what are they doing to control the risk, the accumulations, maybe they're bringing in, they're interested in ways to mitigate the risk. How are they going to do that? Do they bring in outside experts or whatever? But we look at how the risk is managed by those individual lines of business. And that's one of the 5 things that was advocated in that paper we talked about. Then there's another way, and if we want to look at just at internal audit, we say, internal audit needs certain tools to be effective. Do they have those tools? Maybe we'll call those characteristics. Do they have a requirement that the chief internal auditor is independent? Chief internal auditor is appointed by the audit committee. The internal audit is to be comprised only of people with international certification. Does the internal audit have direct reporting to the audit committee? All those things. Does it have a mandate saying what it does? And just listing those doesn't tell you if they're doing a good job. But you can talk to the auditor, you can talk to the chair of the audit committee, you can look at the interrelationships, what the reports are going back. You can look at how the internal auditor takes the findings to the head of the operational unit looking for resolution. If not, going to the chief executive looking for resolution. And if that doesn't work, how does the audit committee intervene to make sure the chief internal auditor's concerns are addressed? So generally, you can get a broad idea, does internal audit seem to work? And then you go back and you look at an individual line of business, and this is automobile underwriting. The auditor picked up all sorts of weaknesses, or the underwriters ignored the control framework. The auditor is doing what he's supposed to be doing. Did the auditor take that back and have those corrected at operational management? If not, was it escalated and escalated? So with two approaches, we believe gives us an idea that we get closer to the answer, is governance effective? And governance for us includes those individual oversight. So it's been a long haul, talking about the responsibilities of the board. I think it's necessary to sit down, talk with boards, make sure they understand your expectation, and we move into a way where we focus on determining whether it's effective. Okay? And at the end of this presentation is an example of supervisory assessment guide that Canada issues for many of these oversight functions, and we give an example for internal audit, but I don't think we want to go through that. And again, a pretty picture. And why, to close up, why do we really go to all this work? We identify areas where risk management is weak, because our job is to push the company to improve it. Where we find functions are working very well, we have to determine what level of reliance we can put on their work. We don't have enough resources to do everything we want to do. How can we use their work? And how can we use their work? Are we going to accept their work without checking or anything? No, we're not. But how far do we check? It depends on the individual company. But we want to be able to use the work that competent oversight functions have done so we can leverage off of it. Their reports are open to us. We can look at the audit work done by the internal auditor in one area. We can go back and do some of that work again if we want to verify the auditor that the audit work was sufficient. Same thing in risk management, same thing in compliance. And by freeing up our time, we can focus our supervisory resources in higher risk areas. And there will always be higher risk areas within the company, maybe risk management of the company, or maybe other companies. So that was hopefully a foray into looking at corporate governance, partially through the eyes of the IAIS, which we in Canada embrace because we think it's a good approach, and an attempt to take it into the practical world of how we can make it work for us as supervisors. So